Pleasure for me to introduce our first speakers today, Mr. Mustafa Saturna, Senior Investment Analyst Saturna Sendian Berhad, for Lesson 1 on the Mind of Investor, Guide to Markets. Mustafa illustrates career started his career with Arthur Andersen in Stuttgart as a business consultant in 1999. He then worked for the world's leading business software house, SAP AG, in Waldorf, Germany. He gained experience in system integrations, internal audit, business technical consulting, change management, enterprise risk management, and strategic planning. Before asset management, Mr. Mustafa worked in international project teams and advised the executive management of various German DAX companies, including Siemens AG, Daimler AG, and BMW AG. Please welcome.
Microphone. Bismillahirrahmanirrahim. Dear Mr. Vincent Ko, MFPC President, dear Mr. Khairul Daim, Organizing Chairman, Tansri, Dato, fellow speakers, members of the media, dear MFPC team, dear finance professionals, dear students, dear friends, Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you for the invitation. It is my pleasure to be here. We have a great speaker lineup and a lot to discuss, not a moment to lose. As the first in line, I will try to set the stage to cover global developments, macroeconomic data, and other questions that are on the mind of investors. So we live in finance. And what do we do in finance? First is discuss risks and disclaimers. Under no circumstances is the information provided sufficient for anyone listening to make investment decisions. Please do your own research. Your risk profile is different from other people. Past returns do not indicate future performance. And every investor should make their own research and read the prospectus. Please, we work so much on them. So for our students in particular today, I heard there are many. We live in the information age, ladies and gentlemen. To filter and make sense of data is essential in our everyday life, especially in capital markets. There is so much information flows coming on a daily basis. I updated my presentation until the last moment, just to cover what's happening everywhere. So, what is on the mind of investors? We have the Russia war going on, inflation going on, recession going on. The global economy is not fit. The news flows are not particularly positive. In fact, we are talking about the USA on one side as a big economy impacting the entire world. Think about the US dollar. Think about Trump's policies and Joe Biden trying to get rid of some of them. Think about US-China. The economy is still recovering, and yet, again, at a highly uncertain moment. The effects of the past 3 years and shocks and calamities are still haunting us. We are still talking about the COVID-19 impact. We are still talking about the Russia invasion or military exercise. I don't know how to call it. We want to stay neutral in Malaysia. Both of these shocks had an incredible impact to everyone's lives, but also triggered a pent-up demand, supply chain disruptions, sky-high commodity prices. Even coffee was so expensive at some point. Palm oil in Malaysia was 4,600? Crazy, more than doubled. Think about the glove manufacturers. and with it, ultimately leading central banks to tightening policy aggressively by raising interest rates. But not only that, they are trying to reduce money supplies. Oh, so I'm not controlling the slides. Can we still go on? Okay. Khalil, you're controlling. I'm already 2 slides further. One more, please. Yes. So I was talking about all the troubles we had, and you're still at the disclaimer. So sorry. So on the next slide, you will see the projections of growth. Is it a soft landing or is it a hard landing? The IMF is a good place to monitor the global state of affairs. The IMF is considered by economists and financial professionals as the institution, even on top of the World Bank, to have the best economists in the world. Normally, the best brains in the world work for them. So there was hope, they would say, the IMF, at the end of this, at the beginning of this year, that the world economy would achieve a soft landing. What does soft landing mean? That we are not in a very harsh, hard hit, steep fall of the economic growth around the world. That can start with US, but can trigger and sweep over to Europe, Asia, and the manufacturer of the world is still China. So if China slows down, everyone is affected. With inflation coming down at the beginning of the year, we thought the story is over, but not anymore. Those hopes are coming down because of stubbornly high inflation. Seems like inflation is there for a while and it's sticky. The recent banking sector turmoil triggered by the Silicon Valley Bank, Signature Bank, and others in the US, but also Credit Suisse rocked the markets. We are not so sure anymore. We are asking ourselves, is our money safe? Is our banking sector resilient? Even as inflation has been declining because central bank continued to raise interest rates and the food prices are coming slowly down. The underlying price pressures remain. But look at the growth projections on the next slide by region. We can see that USA and Europe are simmering around 1% this year, next year. And the middle class economies or emerging markets with middle income nations, they are around 3-4%. And the better performing economies are at 5%. So why are we talking about the recession? And what does a recession mean? Most of us are still young. The average age in Malaysia is below 30, or let's say 30. How many financial crises did we see? So recession would basically mean a lot of us would lose their jobs. We cannot find jobs because there is no. We would have trouble bringing food to the table, reaching to the next months. A recession is really bad. A recession, I lived through 2 recessions, and it was not clear if you have your job tomorrow or not. So if we break down the growth projections by the IMF, by region, US is at the brink and could be in a recession. The euro is at the brink and could be at the recession. And this would be very bad for everyone globally because it will not stay there. So it's important for us to understand what's happening, what is causing these risks. On the next slide, specifically, why do we have inflation and when will it pivot? So the GDP numbers indicated by the IMF slowing down this year. The inflation rate has already pivoted, in fact. It was sky high last year. We would not know when it will pivot. And the central banks are keep raising rates. Why do they do that? Because at some point, if you don't do, money is cheap. People take loans, people go shopping. Remember what we did 2 years ago when taxes were brought down by the government for cars. SST was brought down for a while. People start spending. So if these regulations are loosened, people spend more. When they spend more, when they buy Proton, X50, X70, all these nice cars, because it's cheaper now, then inflation is getting higher. And then the central bank raised interest rates, trying to bring down the economy so people spend less and the inflation comes down. So just wanted to give you some numbers. The Eurozone inflation was at almost 11%. This is unbelievable. I was born and raised in Germany. We never had inflation for 40 years. It's a phenomenon people don't know how to deal with. It came down to 7%, still high. UK is still at 10%. The US inflation was at 9.5%, but they're the most aggressive, as you can see, and inflation came down to 5%. For the students out there, can you name a country that has no inflation at this point? Yes, it's China. China has no inflation. It had inflation at the top at 2.6% last year, but it's literally 0.1% right now. And just to name another country, India, India's inflation was at 7%. They're still spending and raising. The inflation rate is at 4%. So what levels of inflation is good? What do professional forecasters say? On the next slide. What is a good number for inflation? So we have said that inflation is already coming down. But you need to know, you need to remember, for developed economies, we want inflation. Inflation basically means prices are going up every year. So if you know that a car is more expensive next year, phone is expensive next year, you don't wait. You spend your money, so the economy is growing. For emerging markets, the target is around 3%, and for low-income economies for the rest of the world, inflation around 5% would be good inflation. Think about Turkey right now. To ensure this remains the case, major central banks are generally continuing or staying firm in their communication. We're gonna restrict monetary policy. We don't print more money. On the next slide, I wanted to show you how do we break down headline inflation. So we look at the left chart and see that energy is a major part of inflation. And it's coming down now, but Malaysia has very low inflation. Why? Because you are so blessed. We are so blessed in Malaysia. At the pump station, 95 costs you only what? 205, 210, while the international communities or citizens pay a lot for energy prices, right? So we have subsidies here. We don't like them sometimes, we want more, but that's bringing down inflation in Malaysia. On the next, here on the right chart, basically the surprise index, it should show that the current forecast is reliable as it stands today. So we don't expect any shocks in the inflation numbers coming. On the next slide. This is basically what gave a lot of trouble to the world in the last 2 years. The Central Bank of America raising interest rates, and that impacts the entire world. But we have to understand one thing. A central bank has usually a mandate, its objectives. And the Central Bank of Malaysia has one mandate, price stability. But the Central Bank of the US has two mandates. They need to keep the US dollar stable, prices, inflation stable at around 2%. But their second mandate is they have to do that without disrupting the unemployment rate too much. Because if you keep on raising interest rates, the economy is slowing down and companies would release, they don't need so many employees anymore, and the unemployment would raise. I have a few slides later why I think one important factor of a recession is not coming in, and that's the labor market. So we have seen 5.25% central bank rate coming in from the US in the last print. That is 5% to 5.25 as a band. And from now on, you see the predictions. Next year, 1 year from now, we should be around 4.3%, around 1% below today. And in 2 years, we should be around 3.5%, which is 2% lower than today. So what's happening when interest rates are pivoting and coming down? Who are the winners? Who are the losers? On the next slide, we can see basically inflation and interest rates are always to look at in tandem. What we don't want is our money to erode over time. So it is imperative to look at real rates. Please remember, students, real rates in the context of inflation to protect investors from losing purchasing power. What you could buy 1 year ago for 100 ringgit, you cannot buy this year anymore. So this means you're losing purchasing power, and in order to cover that, at least your investments, your EPF, your Amana Saham, your unit trust funds, anything you have in your portfolio should be looked at from a real interest rates perspective. And once adjusted, it reflects the real cost of fund to a borrower and the real yield to a lender or an investor. We know that inflation in most countries is higher than the benchmark rate, which means that we have negative yield at the moment. Malaysia's inflation rate is currently, if I'm not mistaken, at 3.7%, but central bank's benchmark is at 3%. That's minus 0.7%. So if you keep your money in these conditions on the fixed deposit below 3.7%, you may lose purchasing power. We also know that we spend more on groceries and clothing than last year, compared to last year. Further, if inflation is higher than rates, we're going to have a problem. So on the next slide, I wanted to show you that this is not a new phenomenon. We had bulls and bears, bear markets in the past, and they only last so long. So how to look at this chart is we had a 9 months decline in markets last year. It was quite tough. We didn't know what's happening, if this is a multi-year recession. But then this year, markets went up. So this chart is for you to have a look and see if, when or after how many months we can expect a bull market to kick in again. So after a bear market, there is usually a bull market. And on the next slide, I wanted to graphically show you that this is not a new situation. Here I'm charting the last 50 years, 40 or 50 years or so, on the S&P 500 intra-year, meaning annual increases and declines. And as you can see on the very left, in 1980, I think, the chart is a bit slow on my monitor, we had a low year, minus 10%, and only one. And after that, we had an increasing performance at the stock market. And then we had, in the 90s, another negative year, and then 4 years of up markets. And then we had a small negative year in 95, and then we had 1, 2, 3, 4, 5, 6 up markets. My point here is, after a down year, usually there is an up year. And in fact, last year we were at the low, down minus 25% on the big benchmark S&P 500. And this year we are 7 to 9% up for the year already. On the next slide, we can see the ultimate benchmark. I call the S&P 500 the ultimate benchmark. Khalil, the next slide, please. Thank you so much. So the ultimate benchmark means it's something that you should have. The benchmark is an index. In this case, the ultimate benchmark for us financial professionals is usually the S&P 500. It's the American benchmark that is most commonly used and determine the state of the overall economy, not only for the US, guys. Think about Apple, Google, Microsoft. These are global companies. They operate in every economy. And if their numbers is any indicator, it's an indicator for the global economy. And this year, the S&P 500 is already up 7.7%, while last year it went down 25%, 20% or so. And you see, I tabled on the right who beat the ultimate benchmark. The ultimate benchmark, the S&P 500, is a good benchmark. We want to beat it. We want to have it in our portfolio. We want to at least perform like the S&P 500. So gold outperformed. The Euro stocks in the war, right? Europe has to deal with the energy crisis, with Russia invading Ukraine crisis. But the stock market went up almost 14%. The DAX, the highly impacted country from the Ukraine war, in my opinion, is up 14%. The NASDAQ technology index went up 22%. Bitcoin, the super high risk asset we all like or hate, is up 60%. This is unbelievable. So are we really in a negative state of affairs right now? So let's look at the next slide and see if we want to check, ladies and gentlemen, if stocks are cheap or not. What do? Analysts would look at historical averages. And here I've charted the 25-year average of the S&P 500. And the average PE, price earnings ratio, the main number we look at to see if valuations are high or low, is at 16.8%. And then what we do is like, to all the statisticians out there, this is your time now. We do standard deviation +1 and the -1 standard deviation. And we check where the valuations stand compared to historical averages. And we can say, even though the markets came down so much, last year we were below the averages at the S&P 500. This year, not so much. Another way we look at stocks, on the next slide, I have to speed up a little. We look at value stocks versus growth stocks. So value stocks basically pay dividends, are more stable. We know them for 100 years. They are not new. We talk about Pfizer. We talk about Johnson & Johnson. We talk about General Electric. We talk about 100-year-old companies, right? Industrials. We talk about energy giants. And there's always times where value stocks are outperforming growth stocks. And there's times where growth stocks outperform value stocks. And at the moment, the growth stocks are outperforming value stocks. And this means that growth stocks are not so cheap. On the right side, you can see what would happen in net profits if 1% more revenue is gained by the company. And the energy companies would gain 8.4%. Is this good or bad? Actually, it's not so good because this only happens if you have high leverage. So the more debt you hold, the better you perform if markets are up. But if markets come down, revenue come down, you're going into a recession. You don't want to have a lot of debt. On the next slide, we look at small caps versus large caps, another category. You guessed it right. Small caps are higher risk. Large caps are lower risk. Why is that? Because large caps can cover their interest payments, interest expense better. So we look at interest rate coverage ratio, and we can see that small companies and mid-sized companies are on average at 3.3%, while the large companies are more stable, and we are looking at 10 times coverage ratio. And you can see the unprofitable company stocks on the top right in the Russell 2000, another very important index to recall, is going up and up and up. On the next slide, we can see that this leads basically to something we need to get used to. The current state of affairs and geopolitical instability is here to stay for the foreseeable future. All signs point to a turbulent world in the years to come. I don't think US and China will calm. US is provoking Taiwan to stand against China. We have to stay neutral. I don't know. But China says Taiwan is like this will continue to drive volatility in the markets. We basically have to ask ourselves, with this volatility, where do you want to be? Are we heading into a recession? Is it good to keep cash? What are the determinants of recession? On the next slide, please. I wanted to show you how economists are measuring when do we come close or hit a recession. And here we have 1, 2, 3, 4, 5, 6 data points. And I don't want to go into them. You will receive the slides later. Just on the very right of this heat map, you can see that we are not really on green. So the clouds are darkening. We don't have any green data point at the moment. And the main one I would look at is the unemployment rate and how much disposable income we have. On the next slide, another leading indicator for us is to look at the consumer sentiment. If the sentiment is low, people are worried. If they are worried, they don't spend. If they don't spend, the economy is slowing down. So are consumers spending enough? Let's look at the next slide. Just look at the top right. This chart basically compares the GDP growth, the stock market, and the employment rate. The purple number in all the charts is going up. But recently it has come down so much that it is unusual to any previous recession we have experienced. So while all data points, or a lot of data points, show in one direction, we're going to have a recession. It's a matter of time. It's a matter of soft or hard. We can see that the labor market on the next slide does not show signs of slowing. So why is that? In America especially, if you look at the labor market, the unemployment rate is at the historical low. We're talking about 70 years we did not see, 69 years we did not see the unemployment rate that we see today. So everyone seems to be enjoying a salary. And when they enjoy salaries, they are spending. And the government is taking in more tax. So is that an indicator for recession? I don't think so. Labor market is strong. Why? Remember the COVID times, a lot of companies closed. A lot of companies had to release employees. And then when the reopening came suddenly, we were unable to find good employees at a fast pace. And in order to hire them, we had to pay a lot of salaries. We had to pay a lot for consultants to find our employees, staff. And these employees, we don't want to get rid of right now. We spent so much money on them. We trained them. We kept them. We digitally enabled them to work from home. Now we don't want to release them. On the next slide, we can see that whenever the unemployment is high, people are looking for a job. We don't need to pay them very well. But if the unemployment is coming down, in order to keep and hire new, really talented staff, we have to increase our wages, our salaries that we pay to them. And currently, the wage increases is becoming a main indicator that the economy is in a good state in the USA. Why is that? Because if people have good salaries, they can continue spending, and the economy is not coming down so fast. But this, in return, is increasing inflation pressures. And when inflation is not coming down as fast, then interest rates will continue to rise. And if the interest rates rise, a lot of areas are apparently affected. So on the next slide, we can see that the dollar is paining us. Malaysia ringgit, especially for those who are going on holidays or overseas, spending is getting more expensive if the Malaysia ringgit is weakening. And the Malaysia's ringgit is weakening either because our inherent economy is slowing and there is less demand for the Malaysia ringgit due to interest rates and other areas, or the US dollar is strengthening. So, and when is the US dollar strengthening? When the demand for the US dollar is getting higher. So when is the demand for the US dollar is getting higher? Is when the interest rates in the US are higher, currently at 5%, than in other countries, than in other economies. So basically this means the lower right chart shows currently the US dollar interest rates is on average 1.5% higher than in other countries. This creates demand for the US dollar, and the US dollar went up over the last couple of years. Now from 112, the dollar index came down to 102. And the reason for that is because the trade balance is coming down. The trade balance is negative in the US, and if it comes down, it's usually supporting the US dollar. So we are watching the US dollar specifically right now as we talk about the US debt ceiling dilemma. But in my opinion, this is happening every year at this time. In the summer, there is no other news, and the US is discussing the US debt ceiling again. And in the last moment, as every year, there might be a solution, I think. On the next slide, please. What about the energy crisis? The energy crisis seemed to ease, if you ask me. On the chart on the top, you can see the production, and you can see below that the consumption. And in the production, we see the OPEC and Russia is reducing production. But the US is increasing production. Net, we will see. On the consumption side, the two big powers on energy consumption, US and China, are going in opposite directions. US is consuming less oil, while China is firing on all cylinders. But net, it seems to be that the demand for oil is neutral. And because of that, the energy crisis seems to be easing at the moment. Next slide. I wanted to show you that oil is not the only energy source, and the global energy transition is still happening. On the left side, this is a bit like educational, if you want. I wanted to show you that investments in the energy space shifted from renewable energies heavily into battery and electrification and carbon capture and other initiatives. it basically replaced the renewable energy investments. Why is that? The answer is on the right chart. Wind energy is becoming cheaper, solar is becoming cheaper, and nuclear is on the rise. Next slide. I have to wrap it up soon, I guess. I'm so sorry. We can see that the Fed is currently at 5%, and the Malaysian interest rates are lower, much lower. So what does your central bank need to do in order to strengthen the Malaysian ringgit devaluation against the dollar? Is to raise interest rates. One problem we see globally is America seems to be the only country that can raise interest rates so fast. In other economies, one more click, please, Khalid. We cannot raise the interest rates without hurting our currency so fast. And this is the first time in the history where the US interest rates has been risen so fast. On the next slide, we can see this is not the only problem. The central bank printed a lot of money in the US. In fact, so much money, it's unbelievable. It's staggering to imagine how much money. And this money needs to come down. And how they do that is by simply not renewing asset purchases to keep it on their balance sheet. So when a bond, which has a maturity date, expires, they would just do not buy them again. And in this way, they can just phase out and let it run out over time. But this will put pressure on markets, on economic growth, because less money in the market means there is pressures on prices, because less money, on the economy, because money is getting more expensive. On the next slide, please. I wanted to put two fixed income slides, and just to show you, 2 years from now, we were talking about the 10-year treasury bonds in the US yielding around 1.3%. And then it suddenly jumped to 3.9%, 4%. At some point, it was 4.3, 4.4%. And how you're reading this chart is basically looking from the top to the bottom. From the top to the bottom, the red circled one. So interest rates are coming down at the moment compared to last year because inflation is coming down. On the next slide. And how you need to read this chart is basically, again, the 10-year chart is a benchmark. What we want to look at is how does the benchmark do, or my yields do, my fixed income, fixed deposit, my bonds, or my sukuk for Sharia compliant investors do when the interest rates are rising or when the interest rates are falling. So currently the interest rates are rising in Malaysia, but probably at some point they will come back in America first. And if they come down from 5.25% lower, what will happen to my fixed income investments? On the next slide, I'm almost done. I wanted to show you one slide on China. And China is considered by economists still within the COVID reopening process. So with inflation under control, they can focus on stimulus and they can focus on policies, and their GDP growth is relatively healthy compared to other parts of the world. So I would say right now, China is not really a concern. On summary, I think, yes, Khalid, next slide, please. In conclusion, the US economic indicators that are important for us are 5, and only 2 have red flags. Right, manufacturing is at a red flag, but and broad indicators are at a red flag, but consumers are doing fine and the labor market is doing fine. On the next slide, you can see as a conclusion, Europe has one more red flag. Consumer confidence is very low, extremely low in Europe due to the war, most probably. Manufacturing numbers came in not as good, and the Bloomberg Financial Conditions Indicator doesn't show good numbers. So in Europe, we have 3 flags, negative, red flags. In the US, we have 2 red flags. Despite this, on the next slide, what should investors do? Especially important for Sharia registered financial planners and RFPs that are listening today. Crises come and go. Stock markets perform in volatile manners since we are small. Bonds are more stable, but yield lower than stocks. So over a 20 years period, I wanted to show you how various asset classes have performed. And just think about a boring 50-50 split of your portfolio, of your investors, of your clients, sukuk for Islamic and stocks, global stocks in US dollar, they performed in a 50-50 portfolio 14% on average over the last 20 years. That is, these are important numbers for your financial planning. On the next slide, I wanted to show you what is the outlook in Malaysia, in Thailand, in Philippines, in our region, in Singapore. And we can see, in order to do that, we basically look at earnings forecasts and earnings growth. And we see Malaysia's earnings growth this year is expected to come in at 12%, but next year to slow down to 7%. The stock market this year is already down 4%, 5%, right? So is any other country looking better as an outlook? So Indonesia's next year earnings growth forecast is double that of this year, but at a single mid-digit. We look at other countries like Philippines, their earnings forecast for this year is 16%. A very good country is also Thailand at 23% earnings growth. So from this chart, we can see that Singapore is doing well, Thailand is doing well, and will do well next year, and also Philippines will do well. In Hong Kong and China, we see still the COVID-19 reopening story panning out. And the lower part is what sectors in particular will do well this year and next year. With that, I wanted to remind everyone on the next slide, money is not everything. Please think about the planet and the people living on the planet. Don't focus only on profits. The overlapping area is called sustainability. So all our investments should be value-oriented, and our values are the same. Our values are to protect the planet, to protect our children, to protect our religion, to protect what we love. So ask yourself from time to time, and your staff and your employees, what did we do today to achieve anything on the Sustainable Development Goals? Thank you very much. That's all from my side today. We are Saturna in the US, Saturna Capital in the US, and Saturna Sendirian Berhad in Malaysia. On the next slide, next 2 slides if you want. We are managing big pension funds in Malaysia. We have our unit trust funds. We have ETFs in Europe. And I have a very popular daily newsletter that you can subscribe to. It is free for our clients and also friends and for MFPCs. With that, I give back to Putri. Thank you.
All right. Thank you very much, Mr. Mustafa. I am sure that the participant could.
I can't hear you.
You can't hear me?
Now you're back.
All right. Thank you very much, Mr. Mustafa. I am sure that the participant could learn a lot from your session just now. And for dear all participants, we apologize that we have run out of time now. So for those who send the Q&A, so we will answer your Q&A through via email.
I'm still in the live chat for 1 hour. I'm happy to answer the questions. Sorry for the delay.
Thank you so much, Mr. Mustafa.
Assalamu alaikum wa rahmatullahi wa barakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.